Good afternoon, ladies and gentlemen. Welcome to the next in the Admiral Markets Trading Spotlight webinar series. Here we are today to talk about how to trade supply and demand zones. My name is Paul Wallace. I'm your guide for this in the Monday morning or the Monday afternoon sessions. Wherever you are in the world, you're very welcome to join us. We really appreciate the fact that we have a truly global audience there. It's always nice. Thank you for your interactions. We always appreciate it. It's great to have you here joining with us today. So what are we going to talk about today, ladies and gentlemen? As I said, it's about, what is supply and demand. As always, I appreciate we have a broad range of experience in the room for the traders who join us. So we try to sort of cover as much of it as possible. Perhaps you can help me by just putting in the little chat box what, if any, experience you've had of trading supply and demand in the past. Maybe you're experienced at it. Maybe you've never even heard of it. I appreciate we have complete beginners joining us. So if you wouldn't mind just being able to put a sort of drop a comment in the chat box, that helps us, helps me sort of tailor my session accordingly. But we're going to talk about supply and demand zones, and not surprisingly, I'm going to sort of show you where they are found on charts, and we'll talk about how do we use them. Okay, it's all well and good to know what they are, but the important thing is how do we actually use them as traders, and how could we lead them on to trade them. And then what we'll do if there's time, well, we'll take a little bit of a moment to sort of look at live markets. So for those of you who don't know me, who're joining us for the first time, my name's Paul Wallace. I'm sort of a trader and a coach and a mentor to traders. I've been fortunate to have traded for hedge funds and for certain clients. Primarily, I trade FX indices and commodities myself. On my swing and position trading, I'm looking to be a dominant trend trader. And for my intraday trading, I'm primarily a mean reversion trader. So I can see that there's quite a lot of comments there and stuff. It's great. Thank you for joining us. Okay, and Samuel says he's not heard of supply and demand before. Okay, well that's why you're here, Samuel. That's why we're here as well. Okay, to help sort of educate you and give you a little bit of insight. And thanks, Plarman, and all of you who have dropping us comments there in the chat box. As always, we really appreciate it. We really enjoy the interaction. It helps us. We want to try and make these sessions as valuable and as useful for you as possible. And if you're watching this on demand later on either the Admiral Markets YouTube channel or Facebook page, then please feel free to drop us a comment. Just let us know what you think, or maybe sort of put in ideas for possible future sessions. We're always open to hearing what would actually help you the most in your own trading. So as always, here we are, we're Admiral Markets, all right. We're a Forex and CFD broker with over 8,000 financial instruments, and Admiral Markets has offices in over 20 countries and is licensed and regulated across a various range of entities. Admiral Markets provides competitive spreads on very popular trading instruments like Euro, Dollar, and the DAX 30, as you can see there. And you're able to engage with markets using the world's most popular trading platforms, MT4 and MT5, which are available on phone, desktop, and browser. And you also have access to the Admiral Markets Supreme Edition plugin. If you have any questions about Admiral Markets, please get in touch with your account representative, and they'll be very, very happy to guide you. But today, ladies and gentlemen, we're here to how to trade supply and demand zones. Lots of people have heard about trading using supply and demand, but may not be aware of what that actually means. It's a pretty simple concept that allows us to analyze markets and identify possible areas for high probability trades in the future. It's a pretty simple tool to use. However, many people are taught wrong or overcomplicate the use of them. And today in this sort of first part, we'll explain them and share some simple ideas on how to use them. And that's what we're going to do. It's going to be almost like an introduction to supply and demand zones, which you'll be able to take away and sort of go and look at any chart and identify supply and demand zones. And what I'll do is, in the future, I'll do a little bit more of like an advanced session just to sort of dig into, ways that you can refine and improve your understanding of trading of supply and demand zones. But today, It's first time we're talking about it. I appreciate we have a broad range of experience in the room, so hopefully this will give you all a bit of a useful introduction or recap, or maybe even just a little bit of a different way of viewing this particular concept when it comes to trading. So my assistant there has just put a little message in the chat box. If you want to sort of know more about myself and also about my colleagues Marcus and Jens, then you'll be able to sort of click on that link and read more about ourselves and our own particular trading background. Samuel says, can you please leave a link where we can download this after training? What you'll find, Samuel, is that this will be on the Admiral Markets YouTube channel and also in the Admiral Markets Global Facebook page. You'll be able to re-watch this session in all its glory, so you can constantly go back and use it as a referral method in your own trading development. So what is supply and demand? Well, this is the kind of the academic slide just to get us started. As I said, it's the sort of academic slide that basically just gives people a little bit of an introduction. So, what is supply and demand in trading? Well, as you can read there yourselves, goods are bought and sold at what their perceived value is at the time. Same applies for financial instruments, with the expectation that their price will change in the future and will be bought or sold at differing prices, potentially bringing a profit for traders. That's why we're traders. Prices adjust according to willing buyers and sellers, in turn creating supply and demand zones. The sellers represent the amount that is available for sale, supply, while buyers represent the amount available to be bought, demand. It is when there is an imbalance between buyers and sellers that we see a change in price. For example, when there are more willing sellers, price will begin to fall until it finds more buyers. And when there are more willing buyers, price will rise until it finds more sellers. Knowing where these areas are on a price chart will give you an edge and allow you to follow the interests of the sort of big and smart money, the real market movers. We, we're as kind of retail traders, we don't really get the opportunity to sort of move the markets too much, but sort of the bigger, smarter institutional traders who we've talked about in previous sessions and trading spotlights will do, and this will allow us, by understanding supply and demand zones in trading, will actually allow you to sort of give you a little bit of where they leave a footprint, so to speak, in terms of their own trading, and that of course can help us with our own trading decisions. Just take a quick little look at the chat box there, okay? So you can see there for Samuel and for others here that, my assistant's put in a link there where you can watch every one of the videos from the Trading Spotlight series. As I said, please go along, just drop us a comment. If you like it, hit the like button, okay? We always appreciate all the kind of feedback. And there we go. Vincenzo is joining us. It's not a Trading Spotlight session unless Vincenzo is in the room. Hello there. You're all very, very welcome, and it's great to have you here with us today. So, we've just looked there at the kind of academic elements of it, but the truth of the matter is, what does that actually mean for traders, okay? What does that actually mean for us, day in, day out, when we are sat there in front of the screens trying to sort of identify our trading opportunities? Well, as you can see, the supply and demand trading is a trading method where the idea is to find points in the market where the price has made a strong advance or decline, and then we mark these areas as supply and demand zones using simple rectangle drawing tools, which we will do in later on in this particular session. So be sure to sort of stick with us as we go across to sort of the live sort of example of it. The point in which the price has made a strong advance is marked by the trader as a demand zone, and a point where the market has made a sharp decline is marked as a supply zone. The main premise of supply and demand trading is when the market makes a sharp move up or down, the large institutions, so namely things like banks and hedge funds, are not able to get their entire trade placed into the market. Therefore, they leave pending orders to buy or sell at the zone, with the expectation the market will return to the zone and the rest of their trading position will be filled. We'll have a look at that in a little bit more detail over the next slide or two to help us understand the concept better. So, in terms of, kind of identifying a supply or a demand zone in this particular case, First, we look at the chart for an area where price strongly shot up from. Where's demand? Now let's use our drawing tool here to help you here. There we go. We can see here, there, okay, you can see there, basically in these candles, we can see price has just launched itself up there, hasn't it? The buyers have really been in control. And what we can recognize is that in this particular area, there was demand, okay? There was demand, buyers were there keen for whatever reason. The buyers were keen to sort of be buyers there, and we can see price, as you can see very clearly on the chart, launched itself north, okay? I say this every week, okay? I am a better trader than I am an artist, so please bear with me on my artistry skills. But you get the gist. You understand the concept, and that's the clear part. Alternatively, in terms of identifying a supply zone, we can look at chart for an area where price has dropped away from supply. So where we see, here, okay, we can see the price, you can see there yourself, okay, within sort of 3, almost 4 candles, we've made a terrific move down there, haven't we? Okay, we've made a terrific move down, quite a sharp, quite a strong advance. So you'd be able to see that quite clearly on a chart. And whilst I should sort of talk about, whilst we're going to focus on, let's say, a bit of a longer term chart, I'm going to use let's say the daily chart as our sort of kind of main trading chart. This was something that you could utilize on any particular trading chart, okay, any trading time frame, from monthly to 1 minute. Not surprisingly, okay, the longer the time frame, the more accurate, the more sort of validity it has. But you will see that supply and demand zones operate across all time frames. And as I said, we'll focus mostly on dailies here today, just because of the nature of the time and of course the sort of traders we have with us. But it is very important that, as always, what I like to sort of talk about is that, what the concepts we share with you are time frame and instrument agnostic. So here's the interesting thing, okay, and this is what I want you to try and understand, okay, and try and grasp. When we see price moving like that, either very strongly away, okay, very strongly, but it's moving very strongly away from an area of demand, or it's falling very rapidly, okay, from an area of supply. What it is that you'll hear traders talking about this as a bit of a liquidity grab. So what does that mean? Well, liquidity is the ability to buy or sell something without causing a large price change. And that's important for institutions, okay? They want to be able to sort of feed their large orders into the market without being too, without it kind of causing price to change too much, either because they don't want to signal their intentions to other players in the market, or they want to ensure that they're making, the sort of market makers, they're making good profits themselves on the actual trade. They don't want the kind of slippage that all traders deal with. Whenever you see the market move, okay, when you see the market move in a strong direction like that, it is due to a lack of liquidity in the market, not because there are more buyers than sellers, as is commonly taught, okay? Think about it, is that there's a lack of liquidity. When we see a market move strongly up there, okay, it's due to a lack of liquidity in the market. It's a liquidity grab. Price is moving from where area demand is to where the next pool of liquidity is. That's what I want you to try and understand and think about. Vincenzo says that is quite interesting to know. Thank you. You're very welcome, Vincenzo. Okay, it's rare for me to be able to teach you something. You're normally here able to offer all manner of words of wisdom. So it's a great bonus for us to be able to help educate you. And as good traders, we're always, all of us, learning. You never. The moment that you think you know it all is normally invariably the moment that you're about to have a little bit of a drawdown. Okay, all of us will have to remain humble and realize that we never know everything, and that actually we can always learn something from other traders, regardless of their particular age or experience. So, just going on from that kind of liquidity grab, it's because when someone places a market order, it removes liquidity from the market, because the person is placing the market order is essentially demanding that his trade is placed right now. His market order is then matched with someone who has a pending order to sell placed in the market at that zone. If the market order is bigger in size than the opposing pending order, what will happen is part of the market order will be filled, but the rest will remain unfilled. So the market must move higher or lower in order to seek out additional pending orders to fill what remains of that market order. What this essentially means is pending orders add liquidity to the market because they are the orders in which market orders will be matched with. So how does that, what does that actually mean? Well, let's just say that we're operating at a, at a big institution, and, I want to sort of buy, let's say it's going to be more than this, but let's say I'm going to buy, 1,000 contracts. Okay. I want to buy 1,000 contracts in euro dollar, but actually, I'm working for one bank, but my opposition is at another bank. Well, he's only looking to sell, let's say 800. Okay. He's only looking to sell 800 contracts at that area. So what we'll find is that, my 800 contracts will be, taken off, but I'm still left with 200 contracts at that price. Price will in itself sort of rise really quickly, trying to find areas where it could get filled or where it might actually find other areas, pools of liquidity for it to trade within. But what we'll be looking at is that there might still well be up to 200 contracts still here at this area, at this particular demand zone. And that's it. The market remembers these zones, okay? And as a trader, once you're able to print them on your own charts, they give you an idea of where there might be sort of future pools of liquidity that the market may wish to move to. So, as I've kind of mentioned earlier, we as retail traders, we do not trade at a size big enough to affect the market price. Placing and exiting trades is something we never really have to think about generally, okay, in terms of our size. But if you're a trader at a large institution, however, getting in and out of trades can be a big problem. This is why they're always looking for pools of liquidity. We might be trading in, traders here might be trading in like 1 or 2 mini contracts, might even be trading in a couple of full contracts, but a large institution might be trading in 1,000 full contracts, okay? That's the sort of thing where, as I said before, they're trying to feed those into places where they know there'll be liquidity because they want to get, the execution at the price they want, and also they may not want to signal their intentions to markets. Because the trades they place are so big, one of the primary goals of a professional trader is to get a trade placed into the market with as little impact on the market price as possible. And this means finding places in the market where a lot of liquidity exists. Most of the time, pockets of liquidity tend to be found at places where retail traders put their stop losses. Just to put that little nugget away there, okay? That little nugget of information, you can sort of stick that away, and we will come back to that later in this session and in future sessions. So what we can actually see and how we can talk about it is that you all know that price doesn't move in a straight line. You've all seen, how the way price moves on particular charts, but, we know that price as it moves will create swing highs and swing lows. And the extremes of these moves can be marked as bases, just like the ones we've got marked opposite. So quite often you will hear traders who trade supply and demand zones, they're talking about what might be called an RBD, okay? It's a rally. It's a rally followed by a base, followed by a drop. And not surprisingly, the opposite of that is a DBR, okay, where you'll see a drop, followed by a base, followed by a rally. Now, I'm sure you've seen these yourselves plenty of times on, on your own trading charts. As I said, price rarely moves in a straight line. It can move in in various forms of a zigzag. But if you start to be able to sort of identify rally-based drops, RBDs, and drop-based rallies, DBRs, across your charts, well, that will start to give you a little bit of an idea where you might be able to identify possible supply and demand zones. That will just help sort of cue your eyes towards where we are, where we're going, and what we're particularly looking for. So, with that information, how do we actually trade supply and demand zones? How do we use this information? Well, today in this part 1, we're just going to look at some simple setups at the areas of supply and demand. Very often you'll find some traders will just simply look to have a buy order at what they believe is to be a supply, or rather have a buy order at a demand zone, and might have a simple sell order at a supply zone. And that is one way to trade it, and many traders happily do that. Personally, for myself, what I prefer to do is to suggest that you identify the possible zones and then wait to see rejection candles to print in those zones. So you could use something simple price action, like engulfing candles or pin bars, which we've covered in great depth on one of the earlier trading spotlight webinars. If you need to understand exactly what engulfing candles and pin bars are, then go back and find the how to trade with price action in the trading spotlight webinar series. As I said, you'll find it on the YouTube channel, and you'll also find it on the Facebook group as well. But I'll give you just a quick reminder. Sort of the outside bar, or the engulfing candle, all right, it's an outside bar form when the high and the low of the bar fully engulf the range of the preceding bar. It must include the complete engulfment of the entire range of the previous bar, not just the body. Sometimes people just talk about it engulfing the body, but the way I look at it is that it should engulf the complete range of the preceding bar. They don't happen that often, okay, but they are a strong signal when they do occur, and they provide traders with a clue to the next possible move. And what you have to remember about these is, these are a reversal pattern, so it needs to be at the end of something to reverse. Let's just look. So, as I said, it needs to be at the end of something to reverse. These are, we can see here, these are bullish engulfing candles. So I need to see price having come down in a downtrend. This is what I'd be expecting from a drop followed by a base, and then maybe the engulfing candle being the start of the rally. Alternatively, okay, when we're seeing, bearish engulfing candles, that needs to be at the end of an uptrend. Okay, so this would be the rally followed by a base, and I would be expecting and looking for the engulfing candle to be the sign of the start of the drop. Hopefully that makes sense, just that can see that where that fits into what we've talked about just a few slides previously. Also, the rejection or reversal candlestick pattern is something simply called a pin bar, which is very often called, you might call it a high test or a low test, a rejection candle, a hammer, or a shooting star. It's a very popular, very visual candlestick pattern. Lots of people just try and trade them wherever they see them, but there's more to it than that. Understanding a pin bar is about the context, the market environment you find yourself in. As always, as always in everything that we've talked about, is about finding confluence of events. Okay. So Plarman says, in what time frame is better to search for these candles, 4 hour or daily? Well, we'll move on to that in a little bit, if you don't mind, Plarman. We're going to look at the Admiral Markets MetaTrader 4 Supreme Edition in a moment. We can have a little look at that. Generally, a lot of it is to do with your particular risk profile, and also your particular trading patterns of behavior. If you're trying to trade, let's say, around a normal day job, well, then you might actually only be able to trade these on a daily chart. Whereas if you have the ability, you might have the opportunity to trade them on 4 hour candlesticks, okay, during the particular day. What I said earlier is that supply and demand zones, they come across all time frames. These price action candlesticks, okay, you'll find them across all time frames. But just today, for today's session, I'm just going to focus on the daily chart. But if you're an intraday trader, this, the supply and demand zones will, be valid to you. If you're a position trader of monthly charts, equally same again, in that the supply and demand zones are valid to you as well. But good question, Plarman, thank you. So, once again, pin bar, let's just draw in. Remember, it needs to be something to reverse. So we need a drop, followed probably by a base, and the pin bar being the start of the sign of a rally. Okay, same here. Okay, that's what we're looking for. Drop, base, rally. Drop, base, rally. And alternatively, okay, for a bearish rejection candle, well, that's what we need is to see is the rally, the base before the drop. That's what we're looking for. Rally, base, drop. That's what we're actually looking for there, right? Rally, base, drop. So as I said, it's about understanding the context within which you see these candles, where you actually see them on the chart. That is what makes them more important, okay, rather than just trading pin bars or engulfing candles wherever you may see them. So, as always, I like to set you a little task, ladies and gentlemen, okay, and just to, to basically help make sure that you effectively are utilising the information that we're passing to you here. I like to set away homework for you to go away and work on. And so, your task from today's session is just go away and look through your favourite trading instruments. All right, that's it. Just you don't have to go through all of them. Just go through your favourite ones and try and identify possible supply and demand zones. And I'm going to show you how we draw them on the charts in a moment. Also see where you can identify very clear drop-based rallies and rally-based drops. And just take a look at how price reacts when it returned to those areas. All right, when it returned to those supply and demand zones, did it move away from those areas off the back of printing rejection candles like engulfing candles or pin bars? Was that there? Could you actually see that there? Okay, and that's just something to take a note of. So as I say, we give these webinars, but the best way for them to help you is actually to go away, go through what we've shared with you here today, and then just go through and just task yourself for the next couple of days just to work on actually sort of just trying to make sure that you understand these concepts and that you can see and actually engage and execute them on your own chart in your own particular favorite trading instruments. So the conclusions are that supply and demand are areas of interest to traders, all right, because they are zones where price has previously made very strong advances or declines. And we're interested in how price responds when it returns to those zones. And that becomes the basis of a simple trading plan. And we'll dig more into that in the second part of this series, which will be in a good sort of 4 to 6 weeks time. But there's plenty enough here for you to be going on with to just effectively start looking at how you can identify supply and demand zones on your charts. So if you bear with me a moment, what we'll do is we'll switch across to the live markets, and I'll show you how to identify and draw those particular supply and demand zones. But for those of you who join us, okay, we have started the exclusive trading spotlight community. We appreciate here at Admiral Markets that, whilst we do provide and share all these educational webinars, that sometimes you need a little bit more support after the webinar when you need it most, and it gives you a spotlight or a space for you to be able to discuss your trading strategies, upcoming market events, signals, and more with other traders. And you'll be able to see trading updates from my colleagues, Marcus and Jens, and also I'll be placing some on there as well. If you can see my colleague's Marcus, he's very proficient on there, okay, and there's providing plenty of fascinating insights, and we'll be able to talk about markets and how our trades turn out. You'll also be able to see the recordings of any of the webinars that you've missed, and you can just sign up now, and you can register at tradersyard.com. and join this trading spotlight group, tradersyard.com/group/312. And I will actually go on there after this session. I'll be on there for a little bit, 20 minutes, half an hour, to answer any further questions that you might particularly have. And for this moment, okay, for the next few weeks, there's no live account required with Admiral Markets, just an opportunity for you to sort of join in there and become part of the growing community there. As always, don't forget to join us next time, whereas actually what we'll see on Wednesday is my colleague Marcus is going to teach you about how to understand leading and lagging indicators, where he'll talk about the difference between momentum and leading indicators. He's going to provide some popular examples of each and how they work, talk about the pros and cons of each, and that'll be on this Wednesday, okay, which will actually be October 16th. Check the inbox for the webinar link, and then you can also see that it's on the admiralmarkets.com education webinar slide to be able to register for these particular live webinars. As always, there's plenty of analysis and education on the admiralmarkets.com website. And, if you have any questions, okay, if you have any thoughts about today's session, you can always contact us on email at hello@admiralmarkets.com. As I said, you can find all of our sessions on youtube.com/admiralmarkets or facebook.com/admiralmarketsglobal. I hope you found that a useful session. I hope that's given you a little bit of insight. I appreciate it might help to lock the educational concepts in place when we just switch across to the MetaTrader 4 platform, and we'll draw and show you how to sort of where we can find them on particular charts. But so if you'll bear with me for a moment, ladies and gentlemen, what we'll do is we'll switch across and see if that can we can bring that up. So just bear with me for a moment. Okay there, ladies and gentlemen. So here we are on the Admiral Market MT4 Supreme Edition. And hopefully you can all still hear my voice, see me, and you can see my charts. Can you just confirm that you can see them all for us? That'll help us make sure we're all on the right page or the right screen, or example. Excellent. Okay, super. That's great. Thank you, Sandra. Thank you, Andrew. Okay. Thank you, Vincenzo. Super. Okay. So, as I said, we're going to focus just mostly on the daily charts today. Okay. As I said, we could go across all manner of time frames, but we're just going to use the daily chart. Just try and keep it a little bit simple, a little bit clear. I'm just going to move this. Just 1 second. Bear with me. I'm just going to move my. Here we go. Just going to move the toolbars out of the way here. So what I've actually got here is, this is my dollar profile. We're going to focus on dollar on the daily chart. You can see there, it's okay, so dollar profile. For those of you who haven't joined us before, okay, or join me for sessions, what I have is, I have profiles on MT4 set up just for each of the major currencies, and just along with their major trading pairs. So here for the US dollar, what I have here is I've got Aussie dollar on the daily, I've got pound dollar on the daily, euro dollar, dollar Swiss franc, dollar yen, dollar CAD, Kiwi dollar, and then at this bottom right is the actual dollar index itself. Okay, so very quickly, I have a very good view on what's happening with the US dollar. So as I said, let's have a look at the daily chart. Let's start on the top left, okay? And this is Aussie against the US dollar on the daily chart. So remember, what we were saying is that trying to understand supply and demand zones is finding areas where prices advanced or declined from very strongly in the past. Now, just looking at this chart here, this is the latest live charts. Okay, we can see there's a couple of areas, hopefully, that come out to my eye of where price has advanced and declined from very strongly in the past. If I just start over on the top left, we can see here. Let me just bring up my cursor here. You can see the price fell away from here very, very strongly, didn't it? We could all agree with that was actually a very strong decline. So here, is an area where there was a supply zone. Okay, price, we had a bit of a rally, a base, followed by a drop. So what I want to be doing is I want to be just making myself aware of that for the future when price actually comes back to operate there. So this is how I draw my zones. You will find people will do it in different ways, and in part 2 we'll do it. I'm going to be a little bit more advanced about how I identify exact zones, but for today, I just want you to be able to understand and see, rally-based drops, drop-based rallies, identifying zones, okay, and so just being ready for the future. So what I do, okay, and remember, this is my personal take on it, okay, others might do it very differently, is what I like to do is I can just use the shapes tool, the rectangle, and when I'm looking at an area like this here, okay, I will just draw that as a rectangle from that area and project it forward. What I do is, I have my my rectangles. Okay, I color them. Okay, so if it's where I think it's a supply, if I think it's a supply zone, where I'm expecting price to move up to and then be rejected and fall away. Well, then I color that sort of kind of pink on my chart. So it just as it's kind of like a visual reminder for me, because it might take a while for price to come back to these zones. That it just is a bit of a visual reminder for me that when price is moving towards that area, that was a previous kind of a supply zone in the past. And so I'm expecting price to sort of be a bearish rejection from that area first. So it just is a little, it's like a little, little mind hack or trick for myself, just to effectively just get me prepped going forward. So hopefully you can identify that. You can be able to see that the rally base drop there. Okay, so I know in the future, and I can just draw that forward quite considerably here. Okay, I'll just draw that forward just to know that in the future that is an area where I'm of interest to. So, what I look at then is, and if I've sort of drawn one in here already, is we can see here, okay, once again, let me put my cursors on. We can see here that actually the price, we can see price, put it in an engulfing key reversal candle here before, in fact, I put in a couple before price moved up quite strongly away from there, isn't it? So remember, this is, we're looking at an area of demand here, okay? This is an area of demand. So what I do here, what you can probably see is I just drawing in and projecting forward, a rectangle there. And in this case, I color those green because when, if it might take a while sometimes for price to return to that area, well, then actually what I want to be able to see, just remind myself, is that when price comes back down to here, is that I'm looking to be a buyer, okay, I'm looking to be bullish, all right? And so, that's just a little reminder for me. But what I'm also interested in looking here is, I'm just kind of curious, is that we had a rally, and we had a bit of a base here, didn't we? And then we had a bit of a sharp drop down, didn't we? Back to actually to that demand zone. So I would be also drawing in this zone here, okay? Just let's do that. Just going to draw this zone in here, okay, and just project that forward. And so very quickly, I'm just trying to identify, well, there is another possible supply zone. Price rallied up to it, it based, and then it dropped. And so now what I have is, I'm kind of interest because I have, I can see that I have, quite a few supply zones above me. It's just confirming that actually, we've been in a bit of a downtrend there, as you can see yourself. And, now I'd be sort of curious to see any price reverse that comes back up to here. Bring my cursor up to me here in the future. Well, I'd be interested to see how price reacts. I'll be waiting to see, would there be bearish engulfing candles or bearish pin bars being formed there? Whereas here, what we can see is, as price came back down to this zone, we can actually see it placed itself there. See how it placed a bullish pin bar there? Hopefully you can see that, it's bullish pin bar there before it actually sort of just drifted its way north. It drifted its way back up, came down a little bit, then actually put in another bullish engulfing cone after hitting that zone before drifting its way back up there again. So hopefully you can just sort of see that that's just very quickly how you can quickly identify and draw on those zones and then be ready for them when price returns there in the future. I think it's Doina Anchor said, which is the width of the zone. Well, I'm just, for today's session, I'll just sort of just take a bit of a look at where are the wicks, okay, where are the bases and the wicks, okay, and just draw my zones forward from there, okay, just using a little bit of common sense. In session 2, I'll go into a little bit more accuracy about how you can completely sort of tighten up that particular zone. But for today, for first session, all I want to be able to do is to just share with you the opportunity to get an idea of how these zones are created, where they show up, and how we can actually sort of start to build a little bit of a trade plan around. So that was the kind of the Aussie against the US dollar, but let's just have a little look at a few of the others. I'll probably hear pound against dollar. So let's zoom out here, just maybe zoom in a little bit. You can see that there's demand zones that I've drawn in from the past, and actually, while it's here, we didn't really get the sort of the kind of it pushed forward from a little bit. It's not really a surprise because we had that 120 level. But let's just have a little look at the chart here and update it. When I look at it, looking here, I'm kind of interested to see that we had a little bit of a rally. Sort of based, and then we had a very sharp drop forward there, didn't we? We had a bit of a sharp drop forward there, okay? And so what I'll be looking forward is, once again, I'll just be drawing in a rectangle there, projecting it forward, just using a bit of common sense, okay? Just to to give me an idea. And because, with price moved away from there, when price moves up to there, I'll be looking, my view would be, waiting to sort of see, could there be a bearish rejection of that? Hence why that, for me, that zone is now pink, okay? Because when, if it comes back in, could be a couple of months, all right? It could be a couple of months. As price gets up there, it's a visual reminder to me that this is a zone, supply zone where price moved away from in the past. What I'll be looking at here is, in futures, we can see that, there was clearly an older sort of demand zone here that I've drawn in green from a while back, and price double bottom there, okay, before moving up. And we can see there, last week, there was clearly a bit of a move there. We had a little bit of moves there, but price comes up. So I would be keeping an eye on that here, okay? So I'll be keeping an eye on there of interest. As looking at smaller zones, I'll be looking at, okay, just smaller zones here and that. You can see price really fell away from there over 4 or 5 days, didn't it, from that particular area. And if we just take a little look at it, there, if we were to project that forward, well, what we can see is that as when price rallied up here, it put in a bearish rejection candle before it dropped away back into the sort of the bigger, longer term demand zone before it. So as I said, it is possible to sort of, have these zones across all time frames and across the sort of size and width, but with a little bit of practice, a little bit of experience, you'll start to identify, where those zones are. And what we can see here is that, price respected it and fell away, but then the next time it came back up to this zone, clearly those previous orders that had been there, okay, they were fulfilled, okay, and price just actually sailed its way through there, okay. So that zone is, I would call that zone now complete, okay. This is, this was the bigger zone, the bigger longer term demand zone, where we had the big double bottom reversal, followed by the kind of move back down into the area before it flew up. And that's what we'll be looking at. Once again, if price comes back down to this area, we'll be looking to be a buyer. If price gets up to 130, okay, so unsurprising that actually got 130, it's not surprised to see that that would be maybe perhaps the first reaction would be a bearish one as it moved itself up there. So have a look at something like dollar CAD. Okay, we'll just have for the last couple of minutes here, sort of drawn in a few of them already. As I said, it's just a case of, as I said, we're looking at the daily chart here, but just looking and identifying areas where we can see that price has moved away. It's price, we were already sort of must have been a longer, bigger sort of supply zone here. Price came up to it, put in a pin bar before it fell away quite significantly there. So clearly I would be saying that how I'd be looking at is that, well, actually maybe that supply zone needs to be extended from there. We dropped away. We can see that actually price came down, and then it came back up here and then fell away strongly here. Let's just zoom. We fell away strongly here, okay, very strongly there, okay. And so projecting forward, that's sort of a supply zone there. And we can see that next time it came up to it, it literally just touched up to it, okay, and then effectively it fell away all the way from there, okay, on the back of a pin bar. Now, as I said, some people actually would just literally put a sell order in there and a stop the other side of the zone, and that's a feasible way to trade. Personally, I like to see price, play its hand. I like to see how price reacts. That is actually much more important to me. Okay, so even if that means that I have to give up a little bit of my reward, but I have a higher chance of a win rate on my trade, I'm comfortable personally with that. That suits my personal risk profile. Other traders in the room may be different. That's fine. It's about understanding your own risk profile and acting accordingly within that. So there you go, ladies and gentlemen. Hopefully that's just given you a little bit of an insight into, how supply and demand zones are formed, how you can see them on charts, okay, how you can go about drawing them, okay. As I say, just pick your favorite instrument after this and then just go and look at, the sort of the daily chart or even perhaps the chart that you normally trade on, and just start to identify, where are the supply and demand zones, all right, and also have a look at, well, how did price react to previous supply and demand zones? Did it actually get up there and provide a rejection candle that would give you a trade idea or a trade opportunity? Take a look at that, okay, and that I can assure you that putting that time into sort of just practicing and identifying that is time very well spent. As always, ladies and gentlemen, I wish you the best of success in your own trading. Okay, I look forward to speaking to you soon. Okay, on next Monday's session. And in the meantime, I'll be joining the Trading Spotlight community after this session. If you wish to join us, if not, sign up, and please join my colleague Marcus for his session on Wednesday. As always, trade well, and I'll speak to you soon, traders. Thanks.